So this week we're talking about the relationship between interest rates, inflation, and the exchange rates. So I have the IMF website that defines inflation. We discussed this in class a little bit. Inflation is the rate of increase in prices. And we said that every country will have a certain level of basket. And in this basket, they will include whatever they find to be their consumer needs are. So, and based on this, the price of this basket is measured every month, every quarter, depending on the country, but usually every month. And then we actually get to see if the prices are increasing. So we discussed the Fisher effect in class. We said that the real return or the yield of a security of an asset is defined by the nominal interest rate minus the inflation, because inflation eats away from your real yield. So the inflation is the increase of prices, the economy expanding, and the prices are increasing. And you know, some people look at this as what's wrong with it? If the prices are increasing and if our salaries are increasing, then there really is nothing wrong with this picture. However, unfortunately, the idea of price increase in assets, in goods, first of all, may not match with the consumer's purchasing power. And therefore, it might actually lead to people's inability to buy the same quality of living as they did in the past. It may also mean that as the prices are increasing, it is leading to an overheating of the economy, that the economy is running too fast, and therefore this overheating is making investments harder, making spending harder, and therefore eventually it will lead to an economic recession. And we have seen in the past that many countries who have dealt with hyperinflation ended up having recession, in which people simply didn't have any purchasing power left for their simple quality of life. So the idea is that as the economy grows, as the population grows, we want to increase the economy as much as at least to match the population growth. And to have a better life, we want to increase the economic size a little bit more than the population so that we could live better. So there is a certain level of inflation that is okay. However, what is not okay is the overheating of the economy and overheating of prices, so much so that the consumers are not able to spend as much as they did in the past, and their purchasing power is not enough to match their previous standard of living. So the inflation is something that the Federal Reserve or the central banks have to deal with, and they have to maintain a very difficult task, an optimization of economic growth and funding the economy for that growth, and to maintain a healthy level of yields for investments and for economic business cycles, and not to cause overheating. So in 2020, after the COVID, it became known that the inflation level is significantly higher, and therefore the Fed started to take measures as to increase interest rates. So you can see that this is the consumer price index for all urban consumers, and this is provided by the Fed of St. Louis. And this is an index, and like I said, there's a basket of goods that are considered to be the consumer's basket, and they literally price this basket on a monthly basis, and There are different baskets. This one is for all urban consumers. So, the basket will include items that are specific to urban consumers, and they would just keep pricing this. Say 15 eggs, rent, gas, electricity, other utilities and whatnot. So, I mean, the groceries. And then uh, by looking at these prices from one month to the next, we know that the prices are increasing or they're stagnant or if they're decreasing. If they're increasing, it's an inflation. If they are decreasing, that's usually deflation, which could be actually worse. If they're stable, called stagnation. But why the deflation can be worse? Because with an inflation, prices are increasing because there's demand. With a deflation, people are simply thinking that the prices are going down. Why should I actually buy anything now? I might just wait, which kind of kills the demand. When the demand dies, or when the demand dies, it really is hard to fix it. Japan had this problem for many decades, and I think that they're still having issues with it. So we discussed what an index is, but a CPI is also an index. At one point, they actually fixed the level to 100, and from that point on, based on the percentage increase of the goods, the index is increased as a percentage points. So as you go down, you go back to 1947, the index was about 22, and then if you come to today, in September, you actually have an index of 307. So it gives you an idea of what it was in 1947 and what it is today in 2023, and how the prices of these goods have changed through time. And so this is the inflation, but and obviously, like I said, there's certain level of inflation is okay. It's what's not okay is having these significant jumps. So notice how in 2020 we actually have this kind of steeper curve that have gone from say 256 all the way down up to 300 in about 2 years. Now that's an excessive amount of inflation, and that's not simply okay. So, I mean, if you think about like if prices are increasing all that much, and that's about a 50 index points out of 250, so you're looking at approximately 20%, 25% even. Um, and we have this right here. I'll show it to you in a minute. And when you look at salaries, they didn't increase all that much, if at all. That simply left people not able to spend as much money as they did um, for their quality of life, and therefore, all of a sudden, you actually have worse living for individuals, and therefore, um, it people start to feel the effect of inflation. Oops, sorry. So let's take a look at how the year-on-year inflation has changed for the US. And what we mean is, as the consumer price index, and by the way, there are different variations of this, obviously, but there's also the producer price index. But from a consumer point of view, I think the CPI, Consumer Price Index, is a little bit more common for everybody to use. So the way that we look at inflation is the percentage change in this index. So if you look at year on year, what the index was 1 year ago and what it is today, year on year, notice how we actually have significant variation on inflation rate. We have, up in 1940s, we actually had as high as 20%, and in 1920s, we had it as high as 25%. So there are times that we actually had 15%, but recently we have been going on a downtrend, which was actually quite nice. And so, I mean, you're looking at from 1980s all the way till, the 2020 up until COVID, the inflation was on a downtrend, and we have seen very close to no inflation at all. But like I said, a little bit of inflation is actually considered to be healthy for the economy, as you cannot expect the Fed to be as precise. Um, and it also creates employment. It also creates a little bit more business activity. However, having zero inflation, I don't think is a target of Fed, because you always are facing the risk of deflation, which is harder to deal with. And notice that within the past few years, especially after COVID, the inflation literally jumped. I mean, you're talking about almost a 0% inflation because the economy simply stopped during the COVID, and all of a sudden you have a 9% inflation. So at this point, the Fed started to change the interest rate. So let's take a look at the timing. This is the May of 2020, where we had almost a zero inflation. That's May of 2020. And then if you look at this, that is the June of 2022, right? So, and we went from 0% all the way to 9%. And from that point on, Fed started to deal with this high inflation by increasing interest rates. And their system their intervention have worked. And, we are now down to about 3 to 4% range for the inflation. So how does interest rates affect inflation, right? And remember, this week's topic is the relationship between interest rates, inflation, and exchange rates. So we'll come to in three parts of a discussion. This is the inflation, and then on Wednesday we'll talk about the interest rates and how it actually ties into inflation and the Fisher effect and the real inflation versus the nominal inflation. And then on Friday we'll combine in the exchange rates and how it actually is an eventuality of the exchange, of the inflation and interest rates. But let's go back to the discussion about of the inflation. And notice how, again, May 2020 is the lowest point, and then we have June 2022 as the highest point. So what I want to look at is the US Treasury yields, right? And May 2020 is the lowest, and June 2022 is the highest. So we're going to look at that. So let's take a look at 2020, and we're looking at May. Let's look at the 10-year right here in this column, and we are looking at the May. And notice the 10-year yield for US Treasuries in May of 2020, when the inflation is at its lowest. Notice how we are actually coming down all the way from about 2%, all the way down to a very close to 0.5%. See, that's your May, and we actually have about 0.6%. This is a 10-year yield. It simply means that because the inflation was so low, very close to zero, the interest rates in the US for 10 years the 10-year US Treasury yield was about 0.6 or 7%. And that becomes your net yield simply because your inflation is zero, then this becomes your annual return for the duration of that treasury. Now let's take a look at the 2022 June. Well, to begin with, notice how all of a sudden that we are back above the 1.5% level. And as we go through the June, notice now we are at about 3% now. And this is, again, basically showing that with the inflation going up that high, the 10-year yields are trying to catch up. However, these are actually selling at a loss. I mean, if you think about it, if your yield is about 9%, and I'm sorry, if your inflation is about 9% and your yield is about 3.6% or 3%, then you're literally losing about 6% just on inflation. So, but the idea is again, because these treasuries are 10 years and this inflation is year on year, um, the idea is the inflation is not going to stay that high, and you will own a US Treasury for 10 years, and then you will end up having a profitable investment. So the Fisher effect in that sense is the expected real interest, the expected nominal interest, and the expected inflation. So while you're looking at the actual inflation at 9% and the actual yield of about 3.5%, it appears as if we are at a loss of about 6% simply on the purchasing power, and the inflation has eaten away all our yield and then some. But the expectation is that the Fed will deal with this and the inflation will come down and 3.5% will be a profitable investment. So, and the Fed has dealt with it by increasing the interest rates, which we're going to see in a minute. And this literally helped the economy to recover from that unexpected jolt that we have in inflation because of the COVID. Now, why is this important? Well, this is important because you have to, and we have been discussing about the crawfish trade, how the money can travel all around the world. And we also talked about the balance of payments. If the money flows towards a country, it actually increases demand for a currency. It increases investment in a country. It increases production in a country. It creates employment in a country. And it creates a better standard of living for the people of that country. Therefore, as a country, we want the money to come. But the money will only come if the investment is having a real positive return, and that's usually higher than other comparable investments. There are hundreds of countries who offer investment opportunities, and in the US, we offer investment opportunities as well. And from an investor point of view, an international investor point of view, you have all those choices and you can choose US, and your considerations are only two. You care about the risk and you care about the return. And given the risk level, you want a certain level of return. But if the inflation is this high at 9%, and if your investment choice is giving you 3%, well, then there's an obvious dilemma in which you're not just making any money, you're actually losing money. However, during this time, we had significant money flowing towards the US simply because we were considered to be less risky compared to other competition with other developed countries, given the risk level. Again, boils down to not what it is right now, but what is expected it to be in the near future or in the investment horizon of our U.S. Treasury at this example. So the inflation can be 9% right now, and the yield of a 10-year Treasury can be 3.5% right now. But that does not mean that the inflation will stay the same, whereas the price you're paying for this Treasury is what you're actually paying today. And therefore, in 2 to 3 year time, this investment might turn out to be a very good investment, might not, but might turn out to be a very good investment if the inflation comes down. So the fact that the prices are increasing for bonds, for US Treasuries, is a signal that the international investors are choosing to invest in the US with the expectation that this 9% is not going to be staying that long. And people were right. For the past year and a half, the Fed has been increasing interest rates, and therefore the inflation has come down from 9% all the way down to 3%. And nowadays 3.5% to 4%. And the expectation is perhaps for this to come down even more. I think the Fed announcement was that their expectation is to keep it around 2 to 3% with a soft landing, they call it, which simply means that while they're increasing interest rates to deal with the inflation, they don't want to cause a recession. So, having said all of that, in our next discussion, we're going to talk about how interest rates affect the inflation and how, the Fed says we're going to increase interest rates and that should take care of inflation. How does that work? And why is it that for the past 3 or 4 months, even though the interest rates have been increased, we're still having some evidence of continued inflation? And can inflation be that persistent? And and then on Friday we'll talk about how the inflation interest rates, well, the Fisher effect, the real inflation, the real yields, and affect the exchange rate. And if you have any questions, please let me know. And thank you for working with me. And I look forward to seeing you soon, I hope. So thank you. Bye now.